In this video, we will be discussing some concepts for the quiz number 3, especially from the chapter 7 and 8. The first one, the gross versus net method of recording the sales, right? So let's have an example. I think it's always better to have an example than discussing the theories. Okay, so the Sandia company sold supplies of 50,000. Okay, let's make it bold. To Northeast Company on February 20 of the current year, and the terms were 210 and 30. Be careful about the terms 210 and 30. So it is 210, right? So if the buyer pays within 10 days, they will get 2% discount. Okay, so prepare journal entries using both the net method and the gross method. Okay, so first one, the net method. Let's calculate the net amount. Okay, so how do we do that? So let's insert an equation. Okay, so it will be 50,000, then insert multiplied by 1%. That should be actually 50,000 minus 1% of 50,000 is equal to, no, sorry, it's 2%, right? It's 2%. So 2% of 50,000 is equal to, let me calculate. So 50,000 multiplied by 102 equal to 1,000. So 50,000 minus 1,000 is equal to 49,000. Okay, so 49,000. Okay, so we'll be recording accounts receivable. Okay, let's insert another column. Right, okay, so it will be 49,000 accounts receivable debit and sales credit. You can also write sales revenue. Okay, and under the gross method, we don't need to calculate the discount, the 2%. Okay, we will be recording the gross method. So the same thing, accounts receivable debit 50,000 and sales credit 50,000. Okay, so and now number 2, be careful about this one, that is collection from accounts that has already been written off. So let's know the steps. The first one, when we write off an account, what do we do? So under the allowance method, when we write an accounts receivable, we do record allowance for uncollectible accounts debit. Say the amount is 1,000 and accounts receivable credit 1,000. So accounts receivable. Okay, this is the journal entry when we write off the accounts receivable. Okay, but when we know that this accounts receivable is going to pay, okay, so we need to follow 2-step method. So the first one, step 1, we will reverse the write-off entry. So we will reverse the write-off entry, accounts receivable debit and allowance for uncollectible accounts credit. So, and step number 2, collection of accounts receivable. So, very simple. When we collect the accounts receivable, when we receive the accounts receivable, definitely we will debit cash. So, cash debit, and accounts receivable credit. So, what you must notice in this example, see, allowance for uncollectible accounts. So, it is increased. Can you see that? So, accounts receivable increase, first entry, and then allowance for uncollectible accounts increase also. Okay. And calculating accounts receivable balance at the year end. Okay. So, how do we calculate that one? So, let's see an example. So, the company estimates bad debt expense at 0.5% of credit sales. Okay, 0.5% of credit sales. The company reported accounts receivable and allowance for uncollectible accounts of 460,000. Okay, and 2,750 respectively at December 31st. Okay, during 2018, the company's credit sales and collections were 430,000. Okay, and 320,000 respectively, and 2,800 accounts receivable were written off. Can you see that? So what is the balance of accounts receivable at the year end? So to calculate the balance, we need to follow this pro forma. So you have to have this one in mind. So accounts receivable, then credit sales, collections, write-ups. Okay. So first of all, accounts receivable. So our accounts receivable is 460. Okay, yeah, dollar sign is already over there. 460. Then credit sales is 430,000, and we have collection of 320,000. Okay, and we have written off accounts receivable, and that is 2,000. So it should be subtracted, 2,800. Okay, so after calculating, so our final balance would be, so 460 plus 430 plus minus 320,000 minus 2,800. So our final balance would be 567,200. Okay, so this is how you will be calculating the accounts receivable balance at the end of the accounting period actually. And allowance for uncollectible accounts from aging schedule. Okay, so now let's see. The following aging information pertains to Jacobson Company's accounts receivable and at December 31st, 2018. So the days outstanding, amount, and estimated percentage uncollectible. So 0 to 30, 420,000. So 2% in this way. So during 2018, the company write off 18,000 receivables and recovered 6,000 that had been written off in prior years. And Jacobson's December 31st, 2017 allowance for uncollectible accounts was 40,000. Using the balance sheet approach, what amount of allowance for uncollectible accounts should Jacobson report at December 31st, 2018? This is very simple. So let's see how do we calculate this one. So the answer, what is that? Answer would be like this. See. So it is very simple. 2% of this amount, 420, 5% of 140,000, and 10% of 100,000, and 120,000, mean 20% of 120,000. So total 49,400. Can you see that? So you can see that the allowance for uncollectible accounts was 40,000. So this is not gonna affect our new allowance for uncollectible accounts for the 2018. Can you see that? So this is for 2017. But if there were some balances for 2018, we would have to adjust that one. Okay, and now come on physical count of inventory at hand. It's very simple. We have already discussed this kind of problem in our class, and we have also solved one problem. Okay, so now what we need to do, let's read the problem first. So GB company's inventory at December 31st, 2018 was 130,000 at cost. Be careful about this, at cost. So we will be calculating the amount at cost based on a physical count of inventory on hand before any necessary adjustment for the following. So number one, so merchandise costing 20,000 shipped free on board shipping point from a vendor on December 27 was received by Constance on January 5. So what do you think? Did the accountants do it correctly? I mean, this amount, see, this amount is already, this amount has not been recorded. So should we record it? I mean, should we add this one? See, it is shipping point. So here, let me insert a table. Okay, here GB company is the buyer. Okay, GB company is the buyer, and this is the ship in between GB company and another vendor. Okay, so what should we do? Let's see, buyer and seller, and the term is shipping point. Okay, the ship is in between the GB company and vendor. So we are the accountants of GB company. So here GB company is the buyer. So as soon as the ship leaves vendor's dock, the ownership goes to the GB company. So we have received them on January 5, but on December 27 it was shipped. So we are calculating the amount of inventory on December 31st. So definitely this amount should be added. So plus, I'm writing a plus sign over here. Okay, so it should be added with the amount. Number B, merchandise costing 60,000 was shipped to a customer. Free on board shipping point on December 28, arrived at the customer's location on January 6, 2019. Okay, so this amount has already been subtracted from GB company's accounts, and it should be, because in this case, since it is the free on board shipping point, okay, so the ownership has been transferred on December 28. So we need not, so we are writing no entry. Okay, so we don't need to add or subtract. Then number C, merchandise costing 41,000 was being held on hand for J's company, meaning the GB company has merchandise of $41,000 for J's company on consignment. So who is the owner? Definitely GB company is not the owner. So this amount of inventory should be subtracted. Okay. Okay. And now estimated sales returns are 10% of annual sales. Sales revenue was 600,000 with a gross profit ratio of 30%. Oh, here is a trick. So how do we calculate this one? Think that this amount of inventory, meaning the 10% of cost price of sales will be added in our inventory, meaning this amount of items will be returned and they should be added in our inventory. Okay, so now what should we do? We will be calculating cost of the selling, cost of the sales revenue. We can also say cost of goods sold. It should be 600,000 1 minus 0.30. Can you see that? So this is gonna be equal to, so 600,000 multiplied by 0.7. So that is 420. Okay, this is the cost. And so how much should be added with our inventory? So sales return would be 420,000 multiplied by 0.10, 10%. Okay, so 42,000. Make sense? So finally, our final entry will be so total corrected inventory would be start with 130, then plus 20,000 plus minus negative would be 41,000. Okay, and we will be adding 42,000 of sales return, estimated sales return, and the amount would be 130 plus 20 plus 42,000 minus 41,000. It's gonna be 151,000. Make sense? So please watch the video again and again. It will definitely help you for the tomorrow's quiz. Okay, so let's have a recap. So gross versus net method we will be recording like this. And so collection from accounts that has already been written off, so we have to follow these steps, so be careful about that. Calculating accounts receivable balance at the year end, in this case we will be following this one. So the accounts receivable being balance, then we will be adding the credit sales, subtract the collection from the credit sales, and we will be subtracting the write-offs, and finally we have this amount of accounts receivable at the end of the accounting period that allows for uncollectible accounts from aging schedule. It's very simple. So you will just be calculating the percentage of this amount, and this is the amount, and finally the physical count of inventory at hand. So be careful about the free on board, shipping point, or destination, or like that. Okay, so hope you have enjoyed this one and you will be doing better. Thank you.